In this video, I'm going to give you my 3-factor checklist for finding strong supply and demand zone setups. This will make it a lot easier to identify strong setups versus weak setups, which should help you generate more consistent results and keep you trading strong high probability zones instead of the weak zones that make up the bulk of supply and demand zones we see form. Here's the first factor to consider. Let me just preface this by saying all supply and demand zones are important, no matter what type they are or where or when they form on the chart. Every zone must be considered and monitored by you because they're all capable of initiating large reversals. Now, that said, if you only want to take the best supply and demand trades, it's better to focus on rally-based drop and drop-based rally zones over rally-based rally and drop-based drop zones. Here's why. So, the thing about rally-based rally and drop-based drop zones is they always form once a swing is underway rather than set off a new swing like rally-based drop and drop-based rally zones do. Why is this important? Because it means before the zone formed, most traders were doing the opposite to what the banks needed for them to enter their positions. You can see this with the rally-based rally zone below. Being a rally-based rally, this demand formed after price had already risen. Since price is rising, most traders are buying. So when price retraces slightly, few traders sell because overall the market is moving higher. Nobody wants to sell due to the rise. With only a few, well more than a few, traders selling, the banks haven't got many sells to match with their buy positions, meaning they can only buy a small amount to push price higher. As a result, the demand zone isn't that strong. It's formed due to the banks only buying a tiny amount. Price will probably still react to the zone in some way, and it may even set off a large reversal, we don't know. But the probabilities of that happening are low because the banks didn't buy a significant amount to create the zone, so they have no incentive to make price reverse if it returns in the future. Now contrast this with a rally-based drop zone. As you know, these zones initiate the start of new swings and form after price has already been moving in the opposite direction. In our case, price was rising. Then it reversed and a new downswing began, creating a supply zone. Of course, if price is rising, most traders are buying. That's why it's rising. So the banks can sell in much higher quantities, more buyers are free, causing a stronger supply zone to form. Remember, the banks need buyers to sell. The more buyers, or buy orders I should say, it's not really buyers, it's buy orders, they have available, the more they can sell. With the rally-based rally zone, the banks didn't have many sellers as price had already been rising. So when price retraced slightly, only a few decided to sell. Most either stayed long or used the retracement to get long at a cheap price. With the rally-based drop zone, it was the opposite. Price had been rising, the recent trend was up. Most traders were buying, which gave the banks a ton of buy orders to sell with. They could sell more, leading to a stronger supply zone forming. And that's why rally-based drop and drop-based rally zones are stronger than rally-based rally and drop-based drop zones. It all comes down to buyers and sellers. Rally-based drop and drop-based rally zones form from the banks buying or selling a lot more than when they form rally-based rally and drop-based drop zones. That makes the zones stronger because it shows the banks have more confidence price will reverse and continue in the new direction. For all you current supply and demand traders watching this, have you ever heard that strong zones require a sharp move away? Ever hear that from gurus or videos on supply and demand trading? This is one of the key rules for trading supply and demand, but it's one that not only isn't true, but doesn't even make sense. Really, it's the move preceding the zone that determines how powerful it is, and it's down to how the banks enter their positions to create the zone. For a supply or demand zone to form, the banks must buy or sell. Could be from taking profits, placing trades, or closing trades on occasion. Those three actions require the banks to buy or sell, and so create the zones we see. But for the banks to buy or sell, other traders must be doing the opposite at the same time, as I just explained. If the banks want to buy, other traders need to be selling. If they want to sell, other traders must be buying. What this means is how much the banks can buy or sell, and so how much profit they can take, what size trades they can place or close, depends entirely on how many other traders are buying or selling at that time, just before a supply or demand zone forms. That brings us to an important question. How do you determine how many traders are buying or selling? And the answer is you can't, at least not objectively, we don't have the data. What you can do, however, is assess the number based on the prior move. Let me give you an example. See how price had been falling for a long time before this demand zone formed? When price is falling, most traders are selling. That's why it's falling, obviously. But how many are selling depends on how long price has been falling. Because the longer price falls, the more certain it looks to continue falling. That's what the concept of trend is based on, and we know how popular that is. So by looking at how long price has been falling, we can gauge how many traders were buying or selling when the banks placed their positions to create the zone, and thus how strong the zone actually is. In this case, price had been falling for a long time. There are a few bumps, pauses and retracements here and there, but nothing substantial that pushed price in the opposite direction. Overall, price had been falling almost non-stop for at least a week. From this, we know a substantial number of traders must have been selling, which tells us the banks had to purchase a large amount to make price rise. That in turn tells us this is a strong demand zone, because the banks wouldn't purchase such a large amount if they thought price was going to move the other way in the near future. It wouldn't make any sense. So when you analyse supply and demand zones, always look at how long price was moving in the opposite direction before the zone formed. That'll give you some idea of how strong the zone is. If price has been falling or rising for a long time before the zone formed and has only suffered minor pauses and retracements, that means the zone is strong and has a high probability of causing price to reverse. Let's look at the third and final factor to consider. In supply and demand, the entry is as important, if not more so, than finding the right zones and marking them correctly on the chart. It might not seem like it, but it is. The entry tells us when to enter a trade because it shows when the banks may have acted at the zone and so if price is about to reverse. However, one factor no one considers about the entry, the pattern size, and this is something you must know. Pin bars and engulfing candles, though they all form the same way, come in all sorts of shapes, sizes and varieties. Some pins have big wicks, others are only tiny. Some engulfing patterns are small and hardly register. There are endless variations of patterns, but what few traders realise is how a pattern is constructed heavily influences how powerful it is, with the main factor being the size of the pattern itself. Take a look at this engulfing pattern. Overall, this bearish engulf is small. It's made up of two tiny candlesticks. Being so small means that whatever the banks did to create this pattern isn't that significant, hence why it's so small. Now compare that with the engulf over here. Much bigger, isn't it? The first candle is still small, yes, but the engulfing candle itself is way bigger and shows a much larger price change than the other pattern. That's really important because large price change equals more evidence the banks are buying or selling. It shows the banks sold a large amount, hence why price moves sharply lower. Think about it. Most traders are still buying due to the prior rise. So for price to now not only fall but fall sharply, the banks had to overwhelm all those buyers, which they can only do by selling a large amount. Here's a pin bar example. Again, look at how small this pin bar is. It's tiny. I'm not talking about the size of the wick here, which is quite big relative to its body. I'm talking about the overall size of the pin bar itself, from low to high. The whole candle is small. You have to squint at the chart to even make it out. These sorts of pins are not good trade signals. Do not use them. Like tiny engulfs, they show the banks haven't bought or sold in large quantities, meaning they aren't a solid signal price is going to reverse from the zone. Now, big pin bars, however, these are great trade signals you should watch for. Pin bars like this, for instance. This pin is a long wick, much bigger than the body. These are the stereotypical pin bars price action teachers always tell you to watch for. They show the banks entered large positions. That's why the wick is so big, making them a great signal price is about to reverse from the zone. Now, I know that saying watch for big pins and engulfs isn't exactly concrete advice. I mean, how do you know if a pattern is big or small? Really, you just have to use your initiative. For engulfing patterns, watch for a large second candle, the bigger the better. For pin bars, make sure the wick is obvious enough that it catches your eye. This should keep you trading the right patterns while avoiding the really tiny ones.